Welcome all the viewers to Dr. Vijay's lectures on accounting. Lecture number 10. In the previous lecture, we have studied in detail about bank reconciliation statements. Two try by self assignments were given at the end of that lecture. Hope all the serious listeners have tried those assignments. The answer for those assignments are given here at first. Please go through that very carefully and clear all your doubts and confusions. Then we are dealing with two important concepts, capital and revenue. Knowing the meaning of capital revenue is very important in our further study of accounting and finance. Let us go to slide 2. Slide 2 explains the thinking process in deciding whether a cost of difference is to be added or subtracted in the preparation of bank reconciliation statement. Stage 1 is ascertain the given balance. Whether the given balance is overdraft or balance as per cash book or overdraft or balance as per passbook. The second stage is ascertain clearly what exactly is the cost of difference. If you do not understand the meaning of cost of difference given in the problem, you can't do it correctly. The third stage is bring to mind what would have happened if the transaction had been recorded properly in both the books. Where there is favorable balance, check issued. If recorded in both the books, the balance will go down. Check sent to bank for collection. If recorded, the balance will go up in both the books. Where interest on overdraft is recorded in both the books, where there is overdraft, the overdraft will go up. Like that. Next stage is ascertain what has actually happened. What is the cost of difference exactly and what is its impact? Okay. If the impact is the arrived balance happens to be greater than given balance, AB greater than GB, the COD is an item to be added in the statement. If the arrived balance is lower, AB lower than GB, then the COD is an item to be subtracted. If you cannot take decision, when you go through all these stages still, then better draw the model and decide. Slide 3 gives the problem number 1. Given balance as per cash book on 31st December, $10,000. So the given balance is favorable balance as per cash book. What we arrive at is passbook balance as per passbook on the same time. The CODs are number 1, checks issued during the period but not presented for payment, $800. Number 2, checks sent for collection but not collected and credited until 31st December, $750. 3, interest credited in the passbook, $400. 4, charges taken by bank for service rendered, $200. You have to understand that it is for item number 3 and 4, it is recorded in the passbook but not recorded in the cash book. Prepare the bank reconciliation statement and find the balance as per passbook on 31st December. Slide number 4 deals with cost of difference number 1 in problem number 1. The given balance is cash book balance, favorable balance, and the balance to be arrived is passbook balance. COD number 1 is check issued during the period but not present for payment, $800. Any check issued will bring down the favorable balance in both the books. Here, the transaction is recorded in the cash book only. The check is not present at the bank for payment, so the bank has not paid the money and not recorded in passbook. So, the balance as per cash book, that is a given balance, it has gone down. But balance as per passbook remains the same. Balance to be arrived is greater, so the item is to be added. Look at the model if you still doubt. Assumed balance in both the books is 10,000. The checks issued is recorded in given balance, that is cash book, and its balance comes to 9,200, whereas passbook balance, that is balance to be arrived, remains as 10,000 itself. So arrived balance is greater, the item is to be added. Next slide is on cost of difference number 2. Given balance is balance as per cash book. Balance to be arrived is balance as per passbook. COD number 2 is check sent to bank for collection but not collected and credited. Where checks are received and sent for collection, it is recorded in the cash book. When collected, the bank will record it in the passbook. Then both the balances will go up. Balances will go up in both the books. In the present case, it is not collected so far by the bank and so not recorded in passbook. So entry is there only in cash book. The balance as per cash book goes up by 750 rupees. So the balance to be arrived, passbook balance remains lower. So the item is to be subtracted. Look at the model. Assumed balance is same in both the books. Cost of difference number 2, 750 is shown in given balance, that is cash book balance. As a result, the cash book balance becomes 10,750. Arrived balance, balance to be arrived, passbook balance continues to be 10,000 lower. So the item is to be subtracted. Slide 6 deals with COD number 3. Interest credited in the passbook is $400. Means it is not recorded in the cash book, it is implied. Where interest is allowed on the account, in both the books, the balance should go up. But it is recorded only in passbook. So the balance has gone up only in passbook, that is arrived balance. Balance to be arrived. Balance to be arrived is higher. So the cost of difference is to be added. Look at the model. Assumed balance same in both the books. First is given balance cash book. Second is given balance to be arrived passbook. Now the cost of difference, it is shown in second column, 400. So the balance to be arrived, passbook balance goes up to 10,400, whereas given balance remains 10,000 itself. Arrived balance is greater, means the item to be added. Let us go to slide 7. Cost of difference number 4. Given balance is balance as per cash book. Arrived balance is balance as per passbook, both favorable. COD 4 is charges taken by the bank for services rendered, $200. It is recorded normally in passbook, but it is not recorded in cash book. It is implied. Where the service charges are recorded in both the books, the balance will go down. Favorable balance will go down. But it is actually recorded only in passbook. Passbook balance only has gone down. As a result, the arrived balance, passbook balance here is arrived balance, is lower than the given balance. So the item is to be subtracted. Let us look at the model. Assumed balance is given in both GB and AB, $10,000. Cost of difference number 4 is shown in the arrived balance column, that is passbook column, 200. As a result, the passbook overdraft comes down to, passbook balance comes down to 9,800, whereas cash book balance remains the same as 10,000. So the AB is lower, so the item to be subtracted. The reconciliation statement in try by self problem number 1 is given. Bank balance as per cash book, which is given, is $10,000. 2 cost of difference are added. One is checks issued but not present for payment, $800. 2 is interest cut in the passbook, $400. When added, it becomes 11,200 when the 2 items are added. Now, 2 cost of difference are subtracted. Check sent for collection, $750, and bank charges $200. Total to be subtracted, 9,000 950, then what comes is 10,150. Bank balance as per passbook on 31st December is 10,150. Slide number 9 gives question number 2. Try by self problem number 2. Let us go through the question carefully. Given balance as per passbook on 30th June 2021 of Rajan Company is a debit balance of $18,000. Passbook balance is debit balance. It means overdraft. So the given balance is overdraft as per passbook. We have to find out the balance as per cash book. Arrived balance is balance as per cash book. The following are the cost of difference located by the accountant. Prepare bank reconciliation statement. We have to proceed under assumption that bank balance as per passbook is also overdraft. Okay. Now cost of difference number 1. Interest on overdraft charged by the bank $4,200. It is recorded in cash book. Note that sentence. It is recorded in cash book. Now next, bank charges for service provided is $7,300, not recorded in cash book. Now see, interest on fixed deposits credited in the accounts as per standing directions is $12,000, but not recorded in cash book. D. Out of checks issued during the month of $72,000, those amounting to $24,000 are not presented for payment. E. Out of checks sent for collection $50,000, those amounting to $22,000 are not collected and credited in the passbook. Prepare bank reconciliation statement and find a balance as per passbook on 30th June of Raj and Company. Please read slide 10 very carefully. We are solving try by self problem number 2. Please read. Debit balance in passbook means overdraft. Given balance in the problem is overdraft as per passbook. And the balance to be arrived is, that is AB, is overdraft as per cash book. The first cost of difference. Please read that carefully. Interest on overdraft charged by the bank and recorded in the passbook is $4,200. It is recorded in the cash book also, that is given. So it is not a cost of difference and there is no difference. Both the books show the same figure. So it need not be considered in the preparation of bank reconciliation statement. Concerning cost of difference in problem number 2, cost of difference number B. Overdraft as per passbook is the given balance and to be arrived is overdraft as per cash book. CODB. Bank charges for service provided is $7,300. It is not recorded in cash book. It is given the question, it is not recorded in cash book. Where service charges are recorded, what will happen to overdraft? Overdraft will go up in both the books. But in the present case, it is recorded only in passbook, not recorded in cash book. So in cash book, the overdraft remains a lower amount. In passbook, overdraft remains a higher amount. The balance to be arrived is cash book balance. It remains a lower amount, so the item to be subtracted. Please look at the model. Assumed balance in both the books is $10,000. Then this CODB recorded in given balance, that is passbook balance, it is 7,300, and so the new balance 17,300. Whereas in cash book, the balance to be arrived, the balance continues to be 10,000 itself. It is lower, so the item to be subtracted. Slide 12 gives CODC, explains CODC. Given is overdraft as per passbook and the balance to be arrived AB is overdraft as per cash book. CODC is interest on fixed deposits credited in account as per standing directions $12,000, but it is not recorded in cash book. See, interest on fixed deposits is a collection. an income of the account holder. And so when it is recorded, when there is overdraft, the overdraft should come down. Entry has come only in passbook, so overdraft has come down only in passbook. In cash book, it continues to be higher. Cash book is the arrived balance, it is continues to be higher, so the item is to be added. Look at the model. Assumed balance 20,000. Assumed balance, it is an assumed value, you can show any amount. It is 20,000. And the interest is recorded in PB. General given balance, that is passbook balance, 12,000. And the balance comes down to 8,000. Whereas in cash book, that entry is not there and balance continues to be $20,000. The balance to be arrived is higher, so the item is to be added. Slide 13 explains COD-D. Given is overdraft as per passbook and balance to be arrived AB is overdraft as per cash book. The COD-D is out of checks issued during the month of $72,000, those amounting to $24,000 are not yet presented for payment. So, out of the 72,000, only those amounting to 30,000 are presented for payment, paid and recorded in the passbook. Where there is overdraft, if further checks are issued, overdraft will go up. As per cash book, 72,000 has gone up. As per passbook, only 13,000 has gone up. So there is a difference between the two books of $24,000. Okay, in cash book, 72,000 has gone up. In passbook, only 13,000 has gone up. So, as per cash book, overdraft is a higher amount. Cash book is the balance to be arrived, it's a higher amount. So, the item is to be added. Let us look at the model. Assumed balance is 100,000 in both the books. COD-D in passbook, that is given balance, is $30,000. Whereas in cash book, what is recorded is $72,000. As a result, the new balance is passbook balance, that is given balance, would like $30,000. Whereas in cash book, that is to be arrived, balance to be arrived, AB, it is $172,000. So, in the arrived balance, it is greater, so the item is to be added, 24,000 is to be added. Slide 14 gives answer for COD-E. Let's go through. Given overdraft is that as per passbook, and to be arrived is overdraft as per cash book. COD-E is out of checks sent for collection $50,000, those amounting to $22,000 are not collected and credited in the passbook. Only that for $36,000 are collected and credited. Where there is overdraft, if checks are sent to bank for collection and collected by the bank, the overdraft will come down in both the books. But as per cash book, 58,000 has come down. As per passbook, only 36,000 only has come down. Therefore, cash book balance, that is the balance to be arrived, has become lower. So it is an item to be subtracted. Let us look at the model. Passbook, that is given balance, and cash book, that is balance to be arrived, are given. Both are 100,000 assumed. Then the COD-E in passbook 36,000 is shown, in cash book 58,000 is shown. Therefore, the new balance is in given balance, that is passbook balance is 64,000. In cash book balance, that is arrived, it is 42,000. So that is lower. Arrived balance is lower. So the item is to be subtracted. 22,000 is to be subtracted. Slide 15 gives the bank reconciliation statement of Rajan Company on 30th June. The answer for try by self problem number 2. Bank overdraft as per passbook $18,000. Two items are added. Interest on fixed deposits credited in the passbook, not recorded in cash book, $12,000. And checks issued but not present for payment, $24,000. When these two items are added, balance becomes 54,000. Then two items are subtracted. Bank charges not recorded in cash book, $7,300. And check sent for collection not collected and credited in passbook, $22,000. The total amount to be subtracted is 29,300. So 54,000 minus 29,300 equals 24,700. That is bank overdraft as per cash book of Rajan Company as on 30th June end. Okay, now please understand one thing. If the total of items to be subtracted was a bigger amount and the answer was negative value, then we would have come to the conclusion that cash book shows a favorable balance and not overdraft. I am telling it once again. Here the total of items to be subtracted is 29,300. It is to be subtracted from 54,000. Suppose this amount to be subtracted was a bigger amount, say a greater amount, say 64,000. So 54,000 minus 64,000, 10,000 minus 10,000 will come. In that case, we will understand the balance as per cash book is not overdraft. It is favorable balance 10,000. We have tried this in the illustration worked out in lecture number 9. Slide 16 explains the terms capital and revenue. Knowing the meaning of the terms capital and revenue is very important in our further study of accounting and finance. In the vocabulary of finance, the term capital sounds sustaining and long term, and the term current sounds prevailing, subject to change, and short term. The term revenue in the ordinary sense means what comes in. Land revenue departments of governments are responsible for collection of taxes on land. But when used in broad sense in comparison with capital, revenue represents current or short term, whether it comes in or goes out. Funds invested in business, whether owner's fund or borrowed money, investments in assets, reserves and provisions, profits and losses, incomes and expenditures, receipts and payments can all be classified into capital and revenue. Investment in business for a long period, normally it is considered as beyond a period of 1 year, is considered as of capital or long-term nature. And that for a period of less than a year, for certain months or certain days, is considered as of current or revenue nature. Capital revenue explanation continues. Investments in assets of fixed or long-term nature is capital expenditure, but expenditure having short-term impact as monthly salary of employees or monthly rent is of revenue nature. Purchase of land or building, purchase of machinery is all of capital nature. But purchase of goods for sale, stock in trade, and salaries paid to employees, monthly rent paid are all of revenue nature. Profits, loss of stock in trade or in day-to-day business operations are of revenue nature, and that on fixed assets or long-term funds are of capital nature. Profit on sale of furniture and fittings, profit on purchase of land and buildings, profit on issue of shares or debentures, discount on issue of shares or debentures, discount on redemption are all of capital nature. Reserves and provisions meant for long-term purposes are of capital nature, and that meant for covering short-term expenditures and losses are of revenue nature. A reserve for redemption of debentures, a reserve for purchase of fixed assets, sort of capital nature, but a provision for covering doubtful debts, a provision for covering discounts to be allowed to customers, or of revenue nature. Incomes and receipts that relate to long-term assets or liabilities are of capital nature, and those relating to short-term assets as stock in trade are of revenue nature. Our explanation of capital and revenue and this lecture number 10 concludes with this slide. To capitalize something to an accountant means to treat it as of long-term nature. Current is something of short-term and revenue nature, part of the day-to-day operations of the business. Purchase or sale of assets for long-term use in business is of capital nature, while purchase of goods for sale are of revenue nature. Purchase of stationery for use in office is of revenue nature, and purchase of machines and tools, including computers and communication systems, is of capital nature. Whether salaries and benefits going to permanent employees is to be capitalized or to be treated as of current nature, as is done conventionally, is the issue under consideration and in research in human resource accounting. Our lecture finishes. Thank you for your participation till the end. Please subscribe if you have not done so far, and share to your friends and relatives who will be benefited by it. Thanks for your comments and likes.